like to welcome everyone here to the UPHCA CE meeting. This is an opportunity for members of the association to not only get free CE credit, but also to be able to get some great information. This is our annual tax review meeting. Steve has always been so willing and a great supporter of the association and has always been willing to provide this tax review. I think it has helped a lot of contractors over the years, and we appreciate very much Steve from CLA participating in our meeting tonight. And we'll just turn the time over to Steve. The slides, I have those available. I can send those out via email. Actually, when I send this out for people to watch online, I'll put a link there that they can download the PDF slides for his presentation. Also, if your screen only shows a small view of his slides, to the right of the slides is a place where you can enlarge the screen so you can see that a little bit better. So, Steve, we turn the time to you, and again, we appreciate very much your willingness to participate in that. And if everybody will mute their mic except for Steve, that way when you have a question, you're more than welcome to unmute and ask a question, but so that we don't get any background noise. So, Steve, we turn the time to you.
All right. Well, thank you very much, Dave. And I always appreciate the opportunity to present to the association. I've been a long-time member. I don't know how long it's been, Dave. How long have you been there? 10 years? Something like that, at least.
It's about 8-9 years now, yeah.
9 seems like 10, but no, just kidding. But I appreciate the opportunity, and I'm with a firm called CLA. We're a national CPA firm, and we're the Salt Lake office. Our firm is the 8th largest CPA firm in the country, and we have some 120 offices throughout the country, and we do happen to be the largest construction CPA firm. I think we have over 700 CPAs that are construction experts. We probably have 15 or so in our office that have been doing construction for a long time, many of them, but I've probably been doing it longer than anybody in my office. Been probably doing this for well over 20 years, and contractors have always been, the #1 industry that I've dealt with. So with all that, we're going to talk about everybody's favorite subject, taxes. And, sometimes I wonder why it's not something that is more popular, because if you really think about it, if you're a successful contractor that's making money, taxes are probably one of your biggest expenses. And I guess maybe people think that there's not a whole lot that can be done. Taxes are kind of a necessary evil, like death and other things, but that's not necessarily true. And especially for construction contractors, the industry and the way the accounting is done and the opportunities that lie in the tax code for contractors, it can be something that can really make a difference and can save money. And that's what I get up for every day, is to help contractors and other business owners, save taxes, because it's a big expense. So with that, we'll kind of get started here. Let's see, there we go. Okay, we'll start it out. Taxes hated by all. That's right. At least all those that have to pay taxes. I get clients that come to me and they say, Steve, these taxes, what can I do? I'm like, well, there's one thing you do. You can, run your jobs into the ground and be really inefficient and don't make money. And then taxes aren't a problem. But if you are a successful contractor that is making money, again, taxes are a big cost. And so, are you investing in your infrastructure, whether it's your CPA firm or your in-house accountant, or you're doing the research yourself to figure out, what can I do to save taxes? Hopefully you are investing the time and the money to be able to do that. And really, there's only a few ways to reduce taxes. Well, the first, I guess, is like I said, you can be inefficient and lose money, but I don't think any of us want to do that. Um, Depreciation. You buy stuff, right? Especially with contractors. You need a lot of equipment. You need trucks. You need all sorts of things, and those are tax deductible. A pension and a profit sharing plan. Well, hopefully most of you have those already. I mean, I think most of your competitors do, and not only to help out your employees, but pension and profit sharing plans can be really, really good tools to get money out of your business, to diversify, and to set money aside for yourself and your retirement. And we'll talk a little bit more about that later. Tax methods. Well, again, construction contracting offers a lot of opportunities for different tax methods. And that would be, okay, you keep your books, usually generally accepted accounting principles, right? Well, for taxes, there are a whole bunch of different methods for recording your income and thus paying taxes. So something, again, I'll talk a little bit about here in a few minutes. Tax credits and incentives. There's a lot of stuff out there, and especially everything from PPP to the employee retention credit and all sorts of other things. I'll talk about a few of those credits during my presentation. Having good records. I'm an accountant, so of course I'm going to say that, but I've been working with a lot of contractors over a lot of years, and those that have the best in-house accounting system tend to be the most successful. And that's because they can really see what they're doing, and they can also show those numbers to other people, i.e. their accountants, that can help them with tax planning. If we don't have good numbers, it's really hard to do planning. And again, I recommend at least once a year you getting with a professional that knows taxes, hopefully one that knows construction taxes and that can help you. So we're going to talk today about, like I said, equipment depreciation. We're going to talk about pension and profit sharing plans. The qualified business income deduction has been around for about 4 years, and I just want to make sure everybody's aware of that. Meals and entertainment, something that's kind of been a moving target the last few years. I'll update you on that. Tax accounting method changes, again, something to think about, and I'll show you some examples. Possible tax changes in the new exciting political climate, which is, I don't know how exciting it is. It's kind of gridlock most of the time, depending on, it doesn't seem to matter, but we'll talk a little bit about some possibility of some tax law changes. The employee retention credit. The reason I want to talk about that is because there's a lot of people out there trying to sell their services for this particular credit. And I want to just go over some warnings and just some things that make you want to really beware of this. Work opportunity tax credit. We're all looking for good people, and there are tax credits and other opportunities that the government can help you in hiring some disadvantaged groups. So, all right, equipment depreciation. Well, we all know basic depreciation in the contracting business. There's bonus depreciation, which this year, 2022, it's 100%. So anything you buy, i.e. trucks, equipment, yellow iron, tools, all of that is 100% deductible the year that you buy it. New or used equipment, it doesn't matter. Also, if you finance it, I mean, what a great way to get a tax deduction. If you know you're making money and you're going to owe a bunch of money next April, and you need some equipment, I would suggest, if you can find trucks and some of the other things that may be hard to find these days, but if you can find them, I suggest you buy it before the year end. all you have to do is quote unquote put it into service, which means it just has to be available for you to use, and you can borrow money and therefore maybe not even put any money down and get a large deduction, and it's 100% deductible. And with bonus depreciation, it can also put that entity into a tax loss. So it can give you an opportunity to save all sorts of taxes a lot of different ways. And this is something that when we get together with our clients near the end of the year or during the year, we talk about this all the time. And strategic equipment purchasing is very important in the construction industry. Bonus depreciation does finally start to phase out next year. It goes 80, 60, 40, 20%, and then it phases out completely in 2027. So just to let you know, this has been something we've been enjoying for a long time, and that 10-year window is running out and will go away in 2017. So there are some other alternatives that we'll talk about here in a second, but just know that it is kind of going away, and hopefully these things will be renewed because it is one of the tax provisions in the code that really encourages businesses to buy equipment and keep the economy moving. So another method, we've all heard of Section 179. It's a similar accelerated tax method of depreciating your assets. A little bit different. There's some restrictions and some other things, but just to let you know, this one is permanent in the code. So as the bonus phases out, Section 179 will still be there, but it does have limits, like certain dollar amount of equipment that you can buy and deduct using that method, and some other requirements. But again, another way to depreciate and get current tax deductions. And again, we like to sit down and really look at this stuff because there's a lot of boxes to put numbers in on the tax return, and we like to think we look at things in the most advantageous way for our clients. Bottom line, your construction experienced accountant should be able to dial this in, and if they're not, well, may I make a suggestion that you maybe find another accountant that is a little more construction oriented. Real estate depreciation. Well, depreciation for real estate, buying real estate is really not necessarily a good tax move. The depreciation life for taxes is really long. It's 39 years for commercial and 27 and a half for residential. However, there are some ways, a cost segregation study, and this is something I always bring up, and if you have a building that's probably more than $500,000 to $750,000 cost, it probably makes sense to look at this. And basically what it does is it breaks out that building. Say you have $1 million building and you have to depreciate it over 39 years. Well, that's like $40-something thousand worth of a deduction every year. So it takes a long time to burn through that building. But with the cost segregation study, you take the building and you break it down. We study this with engineers and look at the plans and figure, okay, well, electrical computers and office equipment and electrical systems are hooked up to things that are generally 5-year property. So therefore, any electrical system that's broken out in the cost of this building can be depreciated over 5 years. Other types of property, landscaping, signage, cabinetry, lighting, a lot of these things have much shorter lives. But obviously, if you buy a commercial building, you buy a building, it's like, well, here's the price, it's $1 million, and it includes everything. Well, if you go in and break those things down, you can accelerate the depreciation and front load the depreciation quite a bit more. And we've found, I've probably done 30 or 40 of these with my clients, and it probably about 20 to 30% of the cost of the building can be depreciated faster than the 39-year commercial rate. So in other words, you're talking about of that $1 million building, $300,000 of it can likely be depreciated over 5 to 7 to 15 years. So you're going to get a lot of depreciation up front. And if you've owned the building for a while, you can still benefit, and you can maybe even benefit in a larger sense with the cost seg study, because you can take that depreciation all in the first year that you get the study. So in other words, if you've already depreciated the building for 7 years, you've owned it, you've depreciated it at 39 years, well, you go in and do the cost seg study, 300,000 of that building could be depreciated in 7 years or less, then you're going to get a $300,000 deduction that year. Okay, I mean, this is something that Donald Trump and various other real estate moguls have been utilizing for years. And it basically keeps kicking the can down the road. I mean, it doesn't make your taxes go away, but it does give you deductions currently, and you can save money immediately, which is always a good idea. Pension and profit sharing plans. Well, hopefully all of you have one of these. They're not just good for taking care of your employees, they're good for taking care of yourself and your family, and good for saving taxes. The early, well, IRA, I kind of, I guess, characterized each of these as a small vehicle or as a vehicle. An IRA is like a tricycle. Okay, you can get $6,000 to $7,000 deduction. So it's pretty basic. It's pretty easy to set up, very simple, but very limited tax benefit. A SEP, self-employed pension, is a little bit bigger. You can get up to a $22,000 deduction there. So we'll call that a skateboard. A 401k, a 401k that pretty much everyone has now, can get you, again, about a $22,000 deduction for you and your family members that work in the business. So again, a good idea. Then we get into a more formal profit sharing plan, a little bit more like a motorcycle, and that's probably up to $60,000 per person can be deducted through a profit sharing plan. And then, of course,
Steve, could I just interrupt you there for just a
of
moment?
course, yes,
The 401k, if anybody is looking to maybe find something that's less expensive or something that we do have a UPHCA 401k program that takes advantage of some changes in federal law that allows for lesser management costs for that. So give me a call, let me know. And if you haven't established a 401, let me know as well, and we can put you in touch with the people that are helping us out. Thanks,
yeah,
Steve.
sure. And I encourage you, if you're thinking about this and you don't have a 401k, that you do this as soon as possible, because 401k people and profit sharing people tend to be very, very, very busy before the end of the year, because these plans have to be set up before the year ends. So just to let you know, you should jump on that right away if you can. And then a defined benefit, or also known as a cash balance plan, is the, the sports car of this group, in that you can set aside and deduct on your current taxes up to $200,000 or more for the owners, as compared to, I mean, I've got one particular cash balance plan that I work with. They probably, for the two owners, they set aside over $400,000, and then the remaining employees, it cost them approximately $50,000 for all of the rest of the employees. So they're getting a $450,000 deduction, and they're getting 400,000 of it. And so it all depends on the ages of your employees, how long they've been employed, how much they make. etc. There's a calculation that needs to be done to come up with, some good planning numbers. But this is definitely something that my firm does, and we can help with this and run a feasibility study for you to see if that makes sense. I mean, a defined benefit plan is a commitment. It's not like, fully where you can decide to do it or not each year. You do have to make a commitment of 3 to 5 years of making a contribution. So before you do it, you need to make that decision, because there's penalties and other things if you don't do it. But it can be just a huge opportunity. I mean, I've this one client has probably got $2 or $3 million set aside in their plan, their individual plan, over the years. And it's, a way to diversify cash out of your company and get a current deduction. And if you're in the top tax bracket, for every $100,000 you put into this, it's only costing you 60, because it's deductible. So again, tremendous opportunities to save taxes. Qualified business income deduction. This is something that was part of the Trump tax cut back in, I think, 2017, 2018. So it's been around for 3 or 4 years, but it's basically a 20% haircut on your taxable income for a flow-through entity, either a partnership or an S corp or a Schedule C. So really a good opportunity, and construction is one of the industries that this is allowed for. There are other industries that it's not. So it's a good program. And again, it's elected on the business return, but it's deducted on the personal return. So if you want to see if your accountant or tax person has been doing the QBI deduction, take a look at your 1040 for 2021 and look at page 1 of that return, line 13. And most of you should have a number on that, in that box. And again, that would be the amount of 20% haircut on the flow through income from your business or businesses. So it's a really good deal. And, hopefully most of the professionals know about this by now, but they might not. And there are limits as to how this is administrated. And basically it means that, okay, for example, say your company makes $1 million. Well, okay, the potential QBI deduction would be 20% of that, or $200,000. Okay, so that's the potential. However, it's limited by 50% of your W-2 wages. So I guess technically you would need to pay at least $600,000 in W-2 wages in your company to be able to deduct that $300,000 if you had $1 million worth of income. And it's either 50% of your wages paid, or it's 25% of the wages plus 2.5% of the cost basis of your property. So in other words, if you own another company that has a building in it, and you don't, obviously in a partnership like that, you typically don't have W-2 wages. If you don't have any wages, well, 2.5%, if you have $1 million building in there, I guess you would get a $25,000 deduction. So if you paid no W-2, if your only business was, the building, you would get a potential $25,000 QBI deduction. So it's kind of a fluid number, and we tend to work with our clients to try and get their W-2 wages up in their company. So in other words, if the owners are getting distributions out of their flow-through entity, well, maybe it makes more sense to have less distributions and pay the owners more W-2, which then qualifies you for 50% of that, can increase this 20% deduction. So it's a matter of just running the numbers to see what would be best. But again, this is the kind of stuff that you got to do as you get close to the end of the year to be able to figure out, well, we want to maximize our deductions. I want to maximize this QBI. How can we do that? So just some ideas there. And qualified property is, any equipment or depreciable property that you have, and then buildings, typically real estate that you use in your business. And if you happen to make $315,000 or less as a married filing joint in your business, then those restrictions or those limits don't apply. So therefore, you don't need the W-2. You still will get that 20% haircut on your flow-through income. And Brett, Jeff, Ryan, anybody have any questions at this time? Whoops.
I
Right.
Right now.
All right. So yeah, you just should make sure you guys are all taking advantage of these things. Meals and entertainment. Well, that's been something that's kind of been a political football back and forth. In 2021 and 2022, you might already know this, that any meal, food and beverage prepared by a restaurant is 100% deductible. It always used to be 50% for business meals, but now it's 100% at least through the end of this year. Then it'll go back to 50%, I believe, in 2023. So hurry, go out to dinner a whole lot before the end of the year with a business associate. And just to remind you, and you probably already know this too, but maybe not, zero deduction is allowed for pure entertainment. For example, jazz tickets, golf, etc. Pure entertainment is 0% deductible. But if you can throw some food into that entertainment, then the food will be 100% deductible. So talk to your entertainment company, and I think they're doing this at the Jazz Games and various other places, that they gross up the food and put that on the invoice so that at least the suite people are enjoying some sort of a tax deduction. And one thing I do suggest, because I've seen this a number of times with contractors, is they're not accurately keeping track of the different types of entertainment, meals, travel. I mean, many clients throw travel and entertainment together and they have one account. And it's like, well, how much of this is pure entertainment? How much of this is meals at restaurants? And how much of this is travel? So some of those are 100% deductible and some of those are 0% deductible. So we want to break those out in an accurate way so that you can decide or figure out how much to deduct on your tax return. Tax accounting method changes. This is probably one of the most powerful things that the tax law has provided, and primarily for contractors over the last 4 or 5 years. Again, the law changed in 2018 and allowed businesses with average gross receipts of less than $26 million can be on the cash basis for taxes. It used to be, it was a $10 million revenue limit. So we had a lot of clients that were between 10 million and 26 million when this law was enacted, and we went in and changed their tax method from accrual, percentage complete, normal generally accepted accounting principles accounting for their tax return. We switched them over to cash, and generally cash is a lot more flexible for the taxpayer in that it can be somewhat manipulated as you get near the end of the year, and especially if you're growing, which many of us have been doing, over the last several years, and you continue, your receivables are bigger and bigger at the end of each year, it gives you the opportunity to, again, defer taxes. Doesn't make them go away, but it pushes out the taxable income into the future. And again, that's something we always want to consider. Then there are other methods that are available to contractors. And some of you may have heard of the completed contract method, which again is another opportunity, specific construction opportunity to be able to save taxes. And it basically means you don't pay any taxes on the income on jobs that are open at the end of the year. So at the end of the year, any profit that's been accrued on your job is you don't pay taxes on it until the next year. So every year we sit down with our contractors that are on the completed contract method and really try and manage their job schedule. I mean, obviously, you can only do so much. The job is either done or it's not done. But many times they can structure things with their work or somehow show that the jobs are open at the end of the year. The jobs are still open, and 95% is generally considered complete. So it would have to be less than 95% complete at the end of the year to be able to defer that using the completed contract method. And then there are other hybrid methods, have to do with residential, different types of opportunities for contractors. And, even if you're over $26 million, there are some opportunities with residential construction. I know there's been a huge amount of that going on here in the Valley, apartments, etc. There's opportunities to defer even if you're over $26 million. And again, I think there's maybe 10 different methods for contractors that I know of to defer taxes. And so again, this is something where we really look at this and kind of see what the construction mix and what kind of work that you do, and the timing of your payments and your timing of how the whole thing works, and attempt to come up with a method that makes the most sense for you and gives you the most opportunity to save taxes every year. Possible new administration tax law changes. Now, this many times is a big slide that has a lot of information on it. Well, this year, it doesn't. And I think we all know that there will probably be a lot of gridlock coming up in the next couple of years. But right now, our firm and the experts that look at this every day really don't have a lot of prognosis for any changes in the tax law. I know a year or last year, I think I talked about a lot of opportunities, or 1 to 2 years ago, there was a lot of talk about big tax law changes. Well, a lot of those never materialized, and they're not going to materialize for at least another year or two till the next administration comes in. Our wage and benefit survey. Hopefully all of you participated in that. I know I gave copies of this to Dave to get out to all of the members, but we're doing it again. And it basically, the questionnaires will come out in March or April of 2023, and then we publish it typically in May. And if you don't have a copy of this, I mean, this is it's a pretty slick deal. There is approximately 50 different individual positions that have wage information, and I think we had over 100 participants in Utah, contractors, this last year. That was down a little bit from prior years, but we've been doing this. Me and my predecessor firm have been doing this wage and benefit survey for about the last 25 years in Utah, and it's got some really good information. And if you haven't got a copy of it, just go ahead and shoot me an email, and I'll be glad to send you a PDF of it of last year's model. And it is kind of old information, but it still kind of gives you an idea. I think we all know wages have been going crazy. Hopefully, they're going to show some signs of slowing down in the next year. So hopefully, next year's survey will show that they've stabilized a little bit. But I know, at least in my industry, in accounting, it's been going up 10% plus per year, and some a lot more. So just something that would be nice to know. And if you're interested in a copy of that, let me know. All right. Any questions so far? Anybody? Well, I want to talk a little bit about the employee retention credit. And we've been helping clients with this since this came out in 2021. I think it was early 21, maybe even late 2020. And the employee retention credit was a way for you to get help and keep people employed in your business with, having to undergo certain losses and challenges that we've all had to go through the last couple of years. It was another way to get some money from the government. Now, this is not the PPP, okay? Many times it's advertised that, oh, this is another PPP. All you have to do is just sign your name and you get a bunch of free money and you don't have to do anything. Well, this one is quite a bit different than that. You have to qualify for it. And we've helped a whole lot of clients to do that in the last year and a half that it's been out. But there are people out there are companies, outfits out there that are basically sales organizations that are calling every business owner in the valley, and you've probably in the country, and you've probably gotten calls, and they say, oh yeah, we can get you this credit. Yeah, no problem. All you have to do is sign up with us and pay anywhere from 15 to 25% of the credit. And I'll kind of show you how this works in a minute, but they're making hundreds of thousands of dollars to do maybe 20 hours of work. And so their objective is to find one person every week or one business owner that's interested in this, and they're going to be very wealthy. So they don't really care whether you qualify or not, but they say they can help you. Again, this is not PPP. It's not free money. You do have to qualify. And there are two ways to qualify. And the first is the simplest, and this is the one that we probably helped, 30 or 40 clients in our office with this. It's based on quarterly revenues, and 2019 quarterly compared to 2020 and 2021. And quarter over quarter, you have to have certain shrinkage or less. Your 2020 and 2021 income needs to be less than it was in 2019. So it's fairly straightforward to calculate this. And we'll talk a minute about how this works. But then the other way to qualify, and this one is quite a bit more mushy, and this is where your operations, or you've showed damages, operations that have been fully or partially suspended due to a COVID-19 governmental order, proclamation, or decree. This is not a safety recommendation, not because you have to wear masks. This is a government order that shut down a business that affected you. Now, this could be a supplier, it could be a vendor, but we'll talk about that stuff in a minute. Other details. Well, this is a refundable credit, and it's basically an amended of your 941 tax form, payroll tax form, and it's up to $9,000 per employee per quarter. Qualified wages need to be used to sustain full-time employees. You claim it on an amended payroll tax return.
Hey, Steve, this is Jeff.
Hi,
You
Jeff.
said you said 9,000, and the slide says 7,000
Oh,
per.
it's 9. Sorry, it's 9.
It's
No,
supposed to.
it's 7. It's 7. Sorry, it's 7. It's 7. It's $7,000. It's 70% of the wages that you pay employees per quarter, with a limit of $7,000 per employee. Yes, 7,000.
Okay, thanks.
And then one thing people don't know, and certainly these outfits that are calling you and saying, "Oh, I can get you to qualify," they don't tell you that there's a 5-year audit window. This is not typical like an income tax return, which is typically a 3-year window. So once that 3 years is over, you're off the hook, basically. This is a 5-year window. If you'll notice in the news, they've been saying, "Oh, the IRS is hiring all these new agents," and I'll bet you money a lot of those new agents are going to be used to audit this particular credit because it is being abused. I have firsthand knowledge to know that it's there are companies that they were told they qualify that they do not, and we'll talk a little bit about that. There are huge penalties and interest. So if you signed up with one of these outfits and got a bunch of money, there's a very good chance that you'll be audited. And if you're audited 3-4 years from now, there will be large penalties and interest on top of paying the money back. This credit is fully taxable. This is another thing that people don't know, but this credit is fully taxable in the year that the return was amended. So in other words, if you're filing an amended return for the third quarter of 2021 and you get your money in 2022, you have to amend your 2021 tax return and pay taxes, both federal and state, on that credit, because it's basically a reduction in your wages, right? So again, another thing that you may get this money and it's great, but you got to realize you got to pay taxes on it. Go back and amend those returns now. And I guess there would also be a chance that going forward, say you get audited 4 years from now for the ERC. Well, guess what? You had to pay the taxes on the money you received in 2022, but then in 2024 or 2025, when you get audited, the statute of limitations has passed to get that money back and amend that tax return. So there's a chance that you could pay 25% tax on the credit that you received. The credit is audited. You have to pay the credit back plus penalties and interest, plus you can't amend the tax return. And penalties and interest is not a tax deductible thing. So it just can cause a whole snarled mess of problems if you're not careful. Number one method, like I said, quarterly revenue reduction, 2019 versus 2020 and 2021, quarter over quarter. Now, these numbers, this is tax gross receipts. So if you're on the cash basis, you have to run a cash basis financial for each quarter to see if you qualify. If you're on the completed contract method, you would have to look at your job schedule and defer the open work at the end of each quarter to come up with what your taxable revenues were during each quarter to do this comparison. And we've helped many clients with this calculation. And you either qualify or you don't. You're either $1 over or you're a dollar under. And depending on, 2019 versus 2020, quarter over quarter, you have to have a 50% decline in revenue, quarter over quarter. Now, I don't think we've had anybody that qualified for that, because that's like you had to be half. Your revenue had to be cut in half in 2020. Not a lot of our contractors and other businesses had that much of a decline. However, in 2021 versus 2019, it's only a 20% decline. So it's quite a bit easier to qualify. And that's, again, all the ones that I can think of that I helped with, they all qualified in 2021 for the credit using this method. And like I said, of the companies that qualify, 99% of them are using this method, okay? But there's another method, and that's what the 1% are using. Operations must be fully or partially suspended due to COVID-19 governmental order. Sounds good. Some of these outfits are just sending questionnaires to people, and they're filling them out themselves. And it basically says, well, did you have any supply chain issues? Oh, sure. Everybody had supply chain issues. We had supply chain issues. Everybody had supply chain issues, but it's not that simple. You need to have an identifiable and quantifiable damage, and it must be more than 10% of your 2019 gross receipts. So if you're applying for, say, the 2020 first quarter, you take your first quarter of 2019 taxable revenue, and you say that's $1 million. You had $1 million worth of revenue in the first quarter of 2019. Well, you're looking at 2020 and you're going, oh, I had damage. Well, you'd have to have at least $100,000 worth of quantifiable and identifiable damage from a government shutdown to be able to qualify for this. Okay. Again, these outfits that are calling you and saying you qualify, they don't get into those details. And they say, oh yeah, we're going to represent you if you get audited. Well, let's talk in about 3 or 4 years. And if you do get audited, do you think they're going to be around? I don't think they are, but that's up to you. But so if it's a vendor or a supplier, because that's typically what we're saying, you need to get third-party documentation from that vendor and that supplier. The more I drill down on this, and I've really looked into this a lot because I've been getting calls from clients that say, hey, you said we didn't qualify back, last year, and we didn't using that one method, but I've got this guy that says that I do qualify. Well, can you help me with this? And it's like, so we look at it and we go, okay, you need documentation. You need a copy of the specific government order that caused this damage. And the damage, again, has to be 10% of what your 2019 quarterly revenue was, at least. If it's a supplier, I mean, you can say, okay, well, they couldn't make the deliveries of materials that I needed, machinery. You have to prove that you couldn't purchase it elsewhere, and you must experience this 10% damage. Okay, so you have to really look at this and say, okay, yeah, this supplier delayed my materials by 4 months, and I could not buy it anywhere else. Well, okay, you can say that, but if you get audited 3 or 4 years from now, you're going to need to show proof that all these things you're saying were true. Because if you got a $1.7 million refund from the IRS because somebody said that you qualified, you've got to prove this to them. And none of this is discussed when these outfits call. They don't sit down with you and help you put together a defendable package of support for this credit application. They don't. And that can be a problem down the road. And one other thing I found out recently is that there were no federal governmental orders, federal, that qualified, that would qualify you as, there was none. Okay, there was a mask mandate. Well, that doesn't count. It's got to be, they shut down certain industries. Now, there were states back east and in various places. There was nothing in Utah. Utah did not have any government order that shut down an industry or a supplier. But in other states, they did. And especially back east, there were shutdowns. But this is a very, very small window to fit into. And number one is, if you don't have support for this, and all you've done is filled out an application from a company that says they can get you the credit, and you've answered a couple questions and named a couple of suppliers that maybe were slow and that had problems getting materials, well, you've got to demonstrate and document that this truly damaged you, and it has to be quantified to be more than 10% of what your 2019 quarterly revenue was in that quarter. So basically, you got to beware. Okay, any questions about the ERC? And it's just, it, again, we helped a lot of clients with it a year and a half ago, and they either got it or they didn't get it. But now I'm getting calls and people are like, well, this guy says I qualify, and I'm like, well, okay, let's talk about it. And many times it's a real stretch. And all I can say is, if you did get an ERC credit, that you just keep that money somewhere and be prepared to pay that back in a few years, and be prepared. You have to pay taxes on it. You have to go and pay income taxes on it. You need to amend your tax return for 2021 if that's the year that the amended return was for that quarter of payroll. So you have to pay the taxes, and then you just have to wait. And hopefully you won't get audited. But I'm just thinking, there are just a lot of outfits out there that are selling this to people. And I think there's a lot of abuses going on. And I think business owners don't understand that they're on the hook for this. So I'm sorry to spoil your parade, but it's you just got to be really careful. And we
Hey,
are,
Steve.
yeah.
Oh, sorry. Quick question. What's the average charge or percent uh, that the accountants get when they help us out with this? I got to go back and look. I did have somebody help me out with this, and I was
Yeah.
always curious if it was a fair amount or if I got overcharged, or what's the average, do you know?
I've heard 10%, 15%, 20%, and 25%.
Okay, so if I'm somewhere in there from 10 to 25, hopefully down by the 10, I probably did okay.
You did, but you didn't call me, because if we'd have helped you with this, and if you qualified, we would help to see if you qualify. If you did qualify, we would probably charge. I mean, I think our average fee is maybe $5,000 to $10,000.
Oh wow, yeah,
So, because it doesn't take a lot of time, and especially what these guys are doing, that takes no time, because they're not doing anything. They're just saying they're calling on the phone every business owner in the country, and they're finding one out of 200 that answer the call, and they say, oh, sure, I'd love to do this. And then they have you sign a contract, and you're on the hook. You get the money, they get their money, and you're the one that's on the hook, not them.
right.
And Yeah, it's crazy. The last 6 months. I mean, I've got people that are getting called every week from a different outfit, and I've hopefully got my clients trained to just say, no, my accountant's already looked at this, and I didn't qualify, or I did qualify, a year ago using the reduction in revenue method, and but I'm done. Thank you. I'm done. Don't call me anymore.
Right.
So, yeah, I mean, I'd keep that money. I'd keep that money close at hand. Don't spend it, and just again, you've got to pay income tax on this. I mean, I guess you can deduct the amount that you paid this vendor that did this for you, so you can deduct that. But yeah, it could be a real headache for you in the future.
Thank you.
Yeah, thank you. Thank you. May I have another?
Yeah.
No, I mean, I usually like to deliver good news, and hey, we got this great idea to save you taxes, and here's the way to do it. But unfortunately, we typically adhere to the law, and we're not just out fishing for these huge commissions that really are just it's outrageous. I mean, I can understand why there are so many of these companies, because I mean, think about it. If you call 500 businesses and you get one of them to say, I'll do this, and they have a $1 million credit coming, because it's real easy to rack up numbers. If it's $7,000 per employee per quarter that you qualify, and there's 7 quarters that you could qualify for. So say you have 50 employees. I mean, it's like millions, it's millions of dollars, and they're going to get hundreds of thousands of dollars for just getting you on the phone and finding somebody to sell this to. So yeah, it's yeah, I mean, I'll be interested to see how this plays out. And if I'm proven wrong that nobody gets audited, then I'll admit. But I just really think, the IRS is looking for ways to raise money in the most efficient way. And going through an income tax audit that takes, 2 months and all this time, and they don't find any problems, compared to this, where it's like, okay, let's audit everybody that got more than $200,000 in employee retention credit. They could do that in a fraction of the time. And I think that's what a lot of these new auditors are going to be trained to do, because it'll be pretty straightforward. Okay, show me your documentation for you qualifying for this. Oh, I don't have any. I just had supply chain issues. All right, well, sorry, you have to pay this back, plus penalties and interest, because you didn't adhere to the law. So, all right. Anybody else? Sorry to be such a downer. But this is just something that really gets under my skin, because, me and my firm really try hard. We do things right. And these guys are not doing things right, and they're extremely successful. And they're going to be, and they're screwing people, because they're not going to be around when the auditor comes calling. Another credit. Here's a credit that's really great. And I don't know how many people, I mention this every year, and it's a great credit. But basically, what this means is, if you hire people that are in these different disadvantaged groups, and you prove that, you have to fill out a form that goes to the state, and the state has to verify that the person is in this particular um, area, challenged area. But if you do that, you can get up to a $9,000 credit. For example, for a veteran, you hire a vet, and you fill out this form and get it to the state. You can get a $9,000 tax credit for every veteran that you hire. So just something to look at. And again, my firm does a lot of this, and they actually have a program where if you hire somebody, you go through our website and fill out the information, and it's submitted to the state automatically. And if you get a credit, I think we get like $800, and you get to keep the rest. So it's kind of a no-brainer. So there's opportunities like this too. And again, a legitimate credit that takes a little bit of effort, but it can be a real benefit. I mean, we've actually got a call center that has turnover of like 150% a year, and they hire people from all walks of life, and they hire a lot of people in these areas, and they're getting I don't know, $150,000 a year in credit for this. So all right, there you go, Dave. I'm 3 minutes over an hour. So anybody, any questions?
This is your chance to ask.
Well, and then here's my information. So even those on the recording can call me if they say like, "What are you talking about?" Reach out to me. I'd be glad to help you. And
Well,
again,
and I will have a copy of the slides that PDFs of his presentation, and provide that when I send out the recorded link for
yeah,
this presentation. And Steve, thank you.
oh, of
You've
course. And I guess my conclusion is just invest in this taxes and saving taxes and learning about it, and or at least having somebody that can learn about it or knows about it on your behalf, because there again, taxes are a huge hit, and we all want to pay as little as possible legally, and so let's all work together and see if we can do that.
Well, it's been a crazy couple 3 years.
Well, and just wait. I don't know. It seems we're us accountants are always going to have employment. That's for sure. And we do. I do really enjoy what I do, and really helping people solve problems and save money. So, yeah.
Well, appreciate it, Steve.
And
Any questions before we end this?
No, just appreciate your time in doing this. I always look forward to this every year.
all right. Thanks, Ryan.
All right. Hey, thanks, Steve.
Thanks, Steve.
All right.
All right.
You guys,
Take care,
everybody have
everybody.
a good night. See ya.
Good night.